Hello everyone, welcome to our discussion of Chapter 11 and retirement plans. So we're going to do some basics. We're going to talk about when an employer sponsors a plan, and then we're going to talk about individual plans, and then we're going to wrap up with some concepts about annuities. So this will be part one, and then we'll cover the other topics in part two, the other types of plans. So jump right in with some basic terminology. The whole idea is that the tax law is designed to encourage people to save money for when the time comes when they are no longer working, such that that same money can be received as benefits in retirement. So that's what the retirement plans are about. Now, in that same concept, we also have added several ways to save for education. And so that, because they work with some very similar principles, we're going to talk about those types of plans as well, separate from when we talked about some of the tax credits for education. The idea behind most of this, the benefit, the encouragement to save, is that taxation is deferred, not eliminated. Eliminate means you never pay tax on it. Deferral means you're going to postpone the tax till retirement. So the basic idea is that you're going to save money now and pay tax on that money when you take it out of the account at a later time in retirement. The general idea was that you will need less in retirement than you need now, and therefore it will be easier, lower tax bracket to pay the tax later. So we have both, as we mentioned, the employer-sponsored plan where the employer sets up the plan or pays into the plan, and then if you don't have that availability, we have plans that are just for you individually. You can set up regardless of, in absence of your employer having a plan that you can participate in. So some terminology. An annuity is an equal payment that is paid typically under a contract. So it's going to be a regular payment. So we use it in many different cases. If you set up a situation where you withdraw a certain amount of money each year or each month out of an account, that would be typically thought of as an annuity, especially if there's a contract that says that that's what has to happen. The beneficiary is the person who is receiving the benefit from the plan. Contribution is what you put into the plan. Distributions is the amounts you pull out of your plan. Okay? Donor is the person putting money into the plan. All right? If it is qualified, it's referred to as tax deferred retirement, meaning that it follows the rules necessary to get that tax benefit we just talked about, in that you don't have to pay taxes now, you pay it later. To have that benefit, you have to follow rules, and we'll talk a little bit about those. And then there's a trustee. Most of the time with a tax deferred retirement plan, there has to be a separate trustee. That's a bank or institution that makes sure that you follow the rules and that all of the amounts going in and coming out of a plan are accounted for and are reported. So if you put money into a tax deferred plan, that's tracked, and they're going to send you a record of that you can use to justify the tax treatment on your tax return. So the trustee becomes an important institution to help monitor that these all happen the way they're supposed to. Again, referring to tax deferred does not mean tax free. The general rule is if you put it in and it doesn't save you taxes now, or if it does save you taxes now, then it will be taxed when you pull it out. So if, for instance, if your income is $50,000 and you put $5,000 into a plan, and that makes your income go down to $45,000 when it comes time to calculate your taxable income on your 1040, then that means that you saved taxes now. So you put that into a plan and you pull that money back out later, it will be taxed later. Okay? If you put money into a plan now and it didn't impact your taxable income now, then it will be taxable, will not be taxable when you pull it out, at least to the extent that that happened. Okay? If you follow the rules of the plan, it's especially important for employer plans. The employer can have a deduction now, even though it's not income to you as an employee now. And that's the real this extra benefit for an employer plan. So, quick check on our learning. Deferred retirement accounts are essentially tax-free. That's false. There is tax implications. Typically, it means you're going to postpone them, not eliminate them. When you are pulling money out of the plan, that is referred to as a distribution period, and you're receiving distributions. Okay? A KEO plan is actually a employer-sponsored type plan, as are SEPs, Simples, 401k. That's one you've probably heard of. Pension, profit sharing. 403b is essentially a 401k for nonprofit organizations. All right, distributions from pension plans are taxable if the contributions were made using dollars that were not previously taxed. So if you got a benefit when you put it in, it's taxable when you pull it out. So employer-sponsored plans listed there was also, we just went over real quickly. Okay, the ones you probably heard most about, 401k, the Simplified and Simple plans have become more popular for small businesses because they're easier to administer than 401k. They have simpler rules. So these provide benefits to both the employer and the employees, in that the employer can put money into the plan, deduct it now, even though they're not giving it directly to the employee. They're giving it to the trustee. Another example of where the trustee comes in, the employer gives it to the trustee, not directly to the employee, all right? But the employer also doesn't just keep it and say, oh, we'll give it to you later. They give it to a trustee, so that makes it safer. The employer can't go get it if they change their mind. But the employee contributions are not compensation to the employee. So it doesn't show up on your W-2 and is part of your taxable income as an employee. The other thing that goes in all of these plans is that when they earn interest or other types of income inside the plan while it's sitting there, that is not taxable income to anyone. So that part is at least as it's earned, is not taxable income to anyone. And then they won't become taxable to me as an employee until I start pulling it out. Now, two types of plans for employer-sponsored. Defined contribution plans are the most popular. That's what we refer to as 401k plans. This is the employer promises to put a certain amount in to the plan. So they've defined the contribution. All right, and so we don't know how much you'll actually have when it's time for retirement, but the employer does promise that if you put in 5% of your income, they will match that 5% and put 5% as well. So there is a defined contribution. Meaning it is dependent, how much is put in is agreed upon and is based on what's happening right now. How much that accumulates for when you're 65 and want to retire is anybody's guess. because the employer is not promising a certain amount. They're promising that they will put in a certain amount. A defined benefit, which should become less popular because it's so hard to administer and figure out, is we establish how much you need when you retire. So for instance, we promise that you'll receive a percentage of your income after when you quit working at age 65 or 67 or 70 or whatever, that they will pay you so much per month. Well, to make that promise, they have to have put a certain amount aside to this trustee so that there's enough money to pay that out. And that's a hard calculation. But they have promised that when you retire, you'll get a certain amount. Not that they will put in a certain amount, but that you'll receive a certain amount. And you can see why employers probably favor the defined contribution, something they have control over, like how much they put in, rather than stuff that they don't have as much control over, which is how much you'll be able to pull out when you retire. Because the market could change, there could be lots of things that differ between now and the time you retire. So to fit what we call qualified pension and profit sharing plans, they have to fit some rules. And one of them is they have to be non-discriminatory, meaning you cannot favor certain employees over others, especially those that are highly paid employees. So you can't just provide this type of plan for the big wigs, okay, or something like that. You have to make it available for everyone. Now, you can eliminate certain people like part-time employees, those under 21 years of age, those that haven't worked for you for 2 or 3 years. I mean, you can establish some criteria, but it can't be we only cover the managers and above type folks. All right, there has to be minimum vesting rules. Vesting means that if you leave that employer, you get to take the money that's in the plan with you, to take it to another trustee. All right, vesting is how much you take with you. So you can have such that they can't take it all with them unless they stay with the company for a while. But it can't be forever, and it can't be that they never get to take it. There's a minimum amount. And an awful lot of the plans say that it's 100% vested. So as an employee, I can take what I put into the plan no matter what when I leave, but I can also take everything the employer has put in when I leave as well. That means I'm 100% vested. If I can only take 80% of it, then I'm 80% vested. And that could happen maybe I'm only 20% vested in what my employer put in after a year, and then 40% after 2 years, and 60%. There are minimum rules. It has to vest at least as fast as the minimum rules. All right. Contributory plans mean that the employee puts in and the employer, and non-contributory plans mean only the employer puts money into the plan. The employees cannot. A defined contribution plan can't put into the plan more than $57,000 a year or 100% of compensation. Now, those are limits that probably nobody is going to worry about because they're so high. And a defined benefit plan can't generate benefits of $230K, more than $230,000 a year, or 100% of your compensation. So you cannot, someone who makes $500,000 a year cannot receive a pension that's going to pay them $500,000. The most they could receive as a defined benefit would be $230,000. So 401k must meet those non-discrimination rules we mentioned. And see, a 401k is based on the idea that employee makes a contribution, a percentage of their income, and the employer matches or puts it in. And the employer, if the employee doesn't put in anything, the employer can say, we're not putting anything in. So it's up to the employee how much they put in, and the employer could then put in based on the employee choice. See, here's where you run into a problem. It has to meet non-discrimination rules. So if you're lower paid employees don't participate in the plan, then you can't cover the higher employees, because even though employees get to choose, you have to somehow persuade enough people to do it that when employer puts money in, it's not putting too much towards those that are highly paid. Okay? The employee can elect, and again, this is special. It's a lower limit than that 57 for kind of the general limit. The employee can put into 19.5. That goes up, and you'll see this happen on each one of them. How much they can put in increases when they reach age 50. The idea is you're closer to retirement, you need to catch up, you need to put more in, and so we're allowing you to exceed the limit, you might say. Keogh plans are for self-employed folks, people with Schedule C businesses, those that are in partnerships, that sort of thing. Generally, same 57K or 100% of compensation. A simplified employee pension. This is the most simple employer sponsored plan, typically for people who only employee is themselves in their business, but maybe there's a couple of employees. The employer creates an IRA essentially and puts money into it. Maximum is 25% of compensation, up to 285. If their compensation is more than 285, we ignore it, or 57,000. The point is you have to put it all in for every employee. So if you as the owner of the business and you have one employee, if you want to put in 25%, you have to put in 25% of the employee. Simplified employee pensions, the employee does not make any contribution. This is a non-contributory plan. Only the employer puts money into it. And it's fully vested. And you have to cover everyone who meets very low criteria, like make $500 a year, and if they're over 21. So it is very easy to do, but it means you have to basically cover everybody. All right. If you're the only employee, then that's easy. Okay. A simple plan, fairly simple. Same way, this was designed to make it easier for employers that have less than 100 employees. Employee can contribute percentage up to 13.5 and up to 16.5 if they're over 50. And the employer has a couple choices. He can either match up to 3%, meaning you only have to put it in if the employee chooses. And again, this is where an employee gets to choose. So this is a contributory plan. Both the employer and employee can contribute. Or you can put in 2% for everyone, and then now you don't have to worry if the employees put in or not. And under these simple plans, there's no discrimination testing, because essentially you got to cover everybody unless they fit under a certain criteria. And so basically it's everybody, and so you don't have the same discrimination issues that come up with a 401k. So, defined pension plans are either defined benefit or defined contribution. Okay, employees must make contributions to a qualified. No, okay, they do not. Usually they have the choice. Okay, maximum for over 50 for a 401k is a person put in it was 13.5 plus the extra 6,000. And Keogh plan, self-employed is true, and simple plan is for employers under 100 employees. Part 2 will get into individual type plans that are not employer sponsored. They have nothing to do with your employer.